Let's talk about banks, the places that promise to keep your money safe while secretly doing things that would get Goof banned from Monopoly Night. Today, we're going to see how a bank can go completely broke, even if it claims to have millions. And to explain it, we're using one example, Goof. Yes, we're trusting Goof with a bank. What could possibly go wrong? Goof opens his brand new bank. People in town deposit a total of $1,000, and everyone assumes that money sits safely in a vault. But no, Goof does what every real bank does. He loans out most of it because that's how banks make money. So instead of having $1,000 in the vault, Goof is now holding about 100, and the other 900 is gone, loaned out. Probably to someone buying a scooter they definitely shouldn't buy. But the bank still tells everyone they have $1,000 in deposits, even though only a tiny fraction is actually there. This system has a name, fractional-reserve banking, which is a fancy way of saying, we promise your money is safe, but we absolutely did not keep all of your money. Surprisingly, this usually works, because people rarely withdraw everything at the same time. Usually. Now, imagine someone in town starts a rumor. Maybe they saw Goof buy a suspiciously expensive coffee, and suddenly people think, maybe we should withdraw our money just in case. Then everyone shows up at the bank at once. This moment has a name, a bank run. And here's the problem. People are asking for $1,000, but the bank only has 100. That's the entire crisis. A bank run is just too many people asking for cash that doesn't physically exist. It's like promising everyone cake when you only baked one sad little cupcake. So, how can a bank go bankrupt, even if it claims to have billions? Because most of those billions are not actual money. They're loans, investments, assets on paper, and numbers in a database that look impressive, but cannot be turned into cash fast enough. If customers want real money right now, the bank can't sell everything quickly without losing value. And the moment a bank loses trust, people run to withdraw money. And that's when the whole system melts. And it gets better. Banks invest in things that are supposed to be extremely safe, like government bonds. The safest thing you can buy. But when interest rates go up, the value of old bonds goes down, which means the super safe investments suddenly lose money. So the bank is holding assets that are worth less than before. Customers panic. Money gets pulled out. The bank tries to sell assets quickly and loses even more. This exact chain reaction is what caused several real banks to collapse. Not because they were evil, just because math can be mean. So why doesn't the entire banking system collapse every Monday morning? Because there are guardrails, reserve requirements, insurance, capital buffers, strict regulations, and of course the central bank, which is basically the parent that steps in and says, okay, fine, I'll help, but seriously, stop doing this. Banking works because people trust that it works. Once that trust disappears, the bank disappears with it.